Why do financial bubbles occur, and what are their consequences? Financial bubbles are a recurring phenomenon in markets characterized by the rapid escalation of asset prices followed by a sudden and dramatic collapse. Understanding why financial bubbles occur and their consequences is crucial for investors, policymakers, and market participants. Here's a detailed exploration. Speculative behavior driven by investor euphoria and the fear of missing out, FOMO, often fuels financial bubbles. Investors exhibit herd mentality, flocking to assets with rapidly appreciating prices in anticipation of quick profits. Excessive liquidity in financial markets, resulting from loose monetary policies, low interest rates, and abundant credit availability, can contribute to the formation of bubbles as investors chase higher returns in search of yield. Irrational exuberance, a term coined by former Federal Reserve Chairman Alan Greenspan, describes the phenomenon where investors become overly optimistic about future asset price appreciation, disregarding underlying fundamentals and valuations. Financial bubbles occur when asset prices detach from their intrinsic values and become driven by speculative trading, market sentiment, and momentum rather than underlying economic fundamentals. Financial bubbles are characterized by extreme asset price volatility, with prices experiencing rapid upward movements followed by sharp declines as the bubble bursts, leading to significant wealth destruction for investors. Bursting of financial bubbles can lead to economic instability, triggering recessions, job losses, and declines in consumer spending and business investment as investor confidence wanes and asset values plummet. Financial bubbles can expose vulnerabilities in the financial system, particularly if they involve highly leveraged positions, excessive risk-taking, and interconnectedness among financial institutions, leading to systemic risks and contagion effects. Financial bubbles often exacerbate wealth inequality as the gains from speculative trading accrue to a small group of investors, while the broader population faces the brunt of economic downturns and financial losses. The aftermath of financial bubbles may prompt regulatory interventions aimed at enhancing market transparency, investor protection, and systemic stability through measures such as stricter capital requirements, enhanced risk management practices, and improved oversight of financial institutions. Financial bubbles serve as reminders of the importance of prudent risk management, disciplined investing, and maintaining a long-term perspective amid market exuberance. Investors and policymakers often reevaluate their strategies and regulations in the aftermath of bubble bursts, seeking to mitigate the risks of future bubbles and market excesses. Why do financial bubbles occur? Financial bubbles occur due to speculative behavior, excessive liquidity, irrational exuberance, and asset price disconnect from fundamentals. Investors chase higher returns, driving asset prices to unsustainable levels. What fuels the formation of financial bubbles? Excessive optimism, herd mentality, and the fear of missing out, FOMO, contribute to the formation of financial bubbles. Loose monetary policies and low interest rates also encourage risk-taking and speculative trading. What are the consequences of financial bubbles? The consequences of financial bubbles include asset price volatility, economic instability, financial system fragility, wealth inequality, and regulatory responses. Bursting bubbles can lead to recessions, job losses, and wealth destruction. How do financial bubbles impact investors? Investors caught in financial bubbles may experience significant losses as asset prices collapse. Those who bought at inflated prices face wealth erosion, while speculators may suffer substantial financial setbacks when the bubble bursts. What lessons can be learned from financial bubbles? Financial bubbles underscore the importance of prudent risk management, disciplined investing, and regulatory oversight. They remind investors to avoid herd behavior, conduct thorough due diligence, and maintain a long-term perspective in volatile markets. Like the video and remember to subscribe to our channel.